Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below and get back to those. If you didn't watch my video last week on the Canadian credit cycle, debt cycles, how those function and the impact on Canadian real estate, I highly recommend you to go back to last week's video and watch that. It should help contextualize the things that we're going to discuss today. Also, the Saretsky Report for September 2018 is now available. So it's basically a 15-page comprehensive report that I put together, basically detailing the Vancouver real estate market in great detail. Some charts, graphs that you're not going to find anywhere else. My sort of thoughts, things that I'm watching in the Canadian economy, etc. So you can go read that in the link below, and then if you want, you have an option to also subscribe for free, and so you get the updates each month for those reports. But I want to discuss the Vancouver real estate market, the recent data that was published by the Real Estate Board publicly, that the mainstream media is picking up. Obviously, the sentiment that's involved with that data. For anyone that's been watching this channel, these videos, it's probably not that new to you. This is basically everything that we've been discussing, but is becoming more apparent to the typical person in the average public person, basically, that is maybe in the market. That is not maybe following it or doing the research, is now starting to pick up on things that I've been mentioning have been happening for a while now. So I think, first things first, looking at the Vancouver real estate numbers, as discussed, this is the same trend that's been happening. It's just a continuation of said trend. Where if we look, let's start with the Vancouver detached housing market. Again, fewest sales. Like this happened every single month in 2018. Fewest sales for the month of September. It was a 27-year low. That's as far back as my data goes. So the fewest home sales in the city of Vancouver for detached homes. Again, even worse than 2008. This is now, this is basically transpiring into across Greater Vancouver. I believe if the entire Greater Vancouver now is showing the fewest detached home sales, I believe, in 27 years. I think this surpassed 08 as well. I'll have to double check that, but I know for a fact the city of Vancouver is. Inventory is basically muted. What's happening is basically sales have essentially... they're bid bottom. I don't know really how much lower they can go. There's really a lot of these houses are simply going no bid. I mean, a 27-year low in sales at a time when unemployment's at record lows, wage growth has been pretty rampant. You have a lot of population growth, but that's really how depressed the detached market is. Despite that, I'm not sure how much lower that can go. You're actually seeing new listings decrease in September. And the inventory, I believe, on a year-over-year basis actually declined by 2%. So the inventory has essentially been flat over the last couple months. But what's happening is because there's no sales, it doesn't really matter. You don't necessarily need new listings to uptick 20, 30, 40% to see that pressure on prices. Because if you look at it, for the detached housing market, you have 15 months of inventory for sale. The month of inventory currently sits at 15 months. I mean, it's an astronomical number. It's one that we haven't seen in a very long time. So again, not that the new listings have to increase, but we have the same sentiment here. Speaking with a lot of detached sellers, realtors, with their clients, that what we're seeing is people basically taking their house off the market in frustration. They can't get their price. They're going to relist again in the spring. But the problem is, so is every other person is going to be trying to relist in the spring. Everybody has that same mindset that, again, what is going to shift in 6 months? What is going to be the catalyst for the market to suddenly reverse in 6 months? Again, this is something that I'm going to get into later in the video, but I want to get through to the condo market as well. This has been something that has transpired very quickly. It's been a very quick change in the condo market. We had hot bidding wars in sort of December, January, February, even March. It was still a pretty good market. Then after that, it just really started to change, and the conditions are getting worse each month in the condo market. This was the fewest sales in 6 years for September. Again, that's a continuation. But you have basically condo sales are essentially a couple percentage points off of the volumes that we saw back in 2008. Obviously, September 2008 was when Lehman Brothers collapsed, when everybody thought the financial system was going to implode. Well, it basically was. And so you have sales currently in the condo market basically sitting at Lehman Brothers crisis levels at a time, again, when like this is essentially perceived as a strong economy. Everybody is still happy-go-lucky, spending money. Bank of Canada is still in the midst of the rate hike cycle. And you have condo sales at very depressed levels. Inventory is up 77%. New listings are building. So, but the thing is, the condo market, the listings are able to build much quicker because there's so much more turnover, more supply. So we're seeing very weak sales, and so the inventory is allowed to increase quite rapidly. As I've talked about, there's a record number of housing starts and housing under construction that is coming, and that is going to add to the woes. And there's still a lot of pre-sales happening. Per data from Urban Analytics and MLA Canada, October is setting up to be the busiest month for pre-sale condo releases. They're going to release 2,200 units across Greater Vancouver for sale in the month of October. It is the most in 2018. So you're going to have all these pre-sale centers essentially competing with the very depressed resale market. So these are essentially going to feed and compete with each other. Now, I will say one thing, that the condo inventory, albeit that it has increased 77%, it is increasing off record lows. So, you know, the inventory still, from a historical context, is low. We are still seeing some multiple offers on one bedrooms. You know, I wouldn't say it's a terrible market. You know, the one bedrooms are still moving. But again, it's just we also have a lot of two bedrooms that are just languishing there. You still have one bedrooms. Nothing is setting price records. Again, I'd say condo prices are down about 5 or 6% from peak pricing about 6 months ago, which is certainly not as bad as the detached housing market. You know, the average sales price in the city of Vancouver declined 19.7% year over year, so basically a 20% decline. Now, I agree that the average price is certainly not perfect, especially when you have low volumes, but if we look at the MLS benchmark for Vancouver detached homes, which is very, very conservative and is very smooth, so, you know, helps all those fluctuations, it's still showing a 7.6% annual decline. So what's happening is the declines and the slowdown in the real estate market has noticeably spread into the condo market, and everybody is starting to pick up onto it. The sentiment has changed, as opposed to, I need to get in the next month because prices are going to rise. Now the sentiment is, you know, hey, maybe I should wait 3 or 4 months because I think prices are going to go lower. And that really just feeds on itself. It cannibalizes itself. So it's a very important thing to focus on and to watch here moving forward, as the sentiment has changed considerably. And so all these people that are holding out for the spring, I just don't see the catalyst to turn that market around. That really comes back to my last video on credit cycles, where we are today. Everything, I'm looking at this from a personal fascination, as someone that is that watches the economy and you know, all the things that intertwine and all the indicators that I've been telling you to look for, that you need to look for, are transpiring, and those are essentially the drag-on effects of a real estate slowdown in the Canadian economy, which has been predicated on a real estate boom over the last decade. You have housing starts decelerating, as we've talked about in last week's video, but now you have a recent data coming out that Canadian auto sales declined by 7.9% in September on a year-over-year basis. So you have Canadian auto sales actually had their steepest year-over-year decline since 2009. So you have housing sales falling off in Vancouver. In Calgary, they're at a 22-year low in Calgary. Toronto is still in a weak sales market. So you have this Canadian housing basically cratering over, and that's impacting other parts of the economy, such as auto sales. Obviously, the housing market goes, the auto market goes, construction market goes, and these are just going to basically, they are all intertwined. So again, looking at the housing slowdown, looking at the auto sales, to me that's something that's just extremely fascinating. And then you get the sentiment from developers that they're obviously getting nervous now and starting to slow their housing starts. So it's, you know, something that again we're watching for. But then you look at, okay, well, again, trying to sort of peek around corners. I don't think that you can necessarily predict or forecast what's going to come, but all you can do, as Howard Marks says, you know, legendary financial guy, just came out with a new book on market cycles, talks about, is that you can't really forecast or predict what's going to happen. Nobody really knows because these markets are so complicated, but what you can do is sort of look and see where are we in the cycle and try to use your best judgment, and that's really my whole emphasis behind things. You know, looking from that perspective is, again, you have the housing sales and the auto sales rolling over, but you have mortgage loan growth on a year-over-year annual basis. Now at the, as I believe it was at 3.1%. This is per BMO, Bank of Montreal, and this is obviously available through the Bank of Canada statistics. But you have mortgage year-over-year loan growth now at its weakest year-over-year pace since the 1980s. You haven't had mortgage credit growth from a year-over-year perspective this anemic since the 80s, which was obviously a nasty housing downturn. But again, we had so you have this mortgage, this really pathetic mortgage growth, because households are essentially tapped out. You have the B20 mortgage stress test, etc. Mortgage is getting very, very tight. Credit has gotten very tight, which has allowed this boom to explode and expand. It is now contracting at a time when, again, it's contracting in arguably pretty good economic conditions in Canada. Again, unemployment is for September came out at 5.9%. We shed a whole bunch of full-time jobs, but we gained some part-time jobs. Funny, because all the job growth and wage growth was actually, again, in BC and Ontario, and they said it was all in construction. So, but again, this weak mortgage data is coming at a time when the economy is still relatively healthy. You're actually still in the midst of a rate hike cycle. The Bank of Canada is going to hike rates in October. That's almost essentially baked into the pie. January the consensus seems to be that's probably a go. I personally don't see how much further they're going to get, because I think this data is really showing signs of it's a red flag. There's so many red flags in the data that I don't know how much further the Bank of Canada is going to get past those two hikes, but some of that is out of control, such as the bond market. You can look at the Canadian 5-year yield recently hit a 7.5-year high, and then obviously the 5-year yield is what prices 5-year fixed mortgages. So, you know, you have a lot of things that are coming together that we've been talking about, forming this thesis for quite some time now. All those pieces amazingly are falling into place. And then I hear, you know, sellers saying we're going to hold out to the spring, as if what is the catalyst to make those conditions better in the spring? Because when credit cycles roll over, they don't just fall and then tick back up. They don't just change direction in 6 months, especially after you add on a couple interest rate hikes. So to me, personally, again, I'm not a forecaster, but I personally wouldn't be advising anybody that is trying to sell their house or thinking about selling their house to try to wait for that spring market, because I do not perceive conditions to be better. But again, could very well be wrong. Just trying to see it in my notes here if there's anything else that I can really discuss. I think that the big story here, I mean, if we want to add on one small caveat, I'm not really sure at this point, based on the regulations, that this is going to make much of a difference. But I will say they are actually bringing in regulations into the Mortgage Investment Corporation side, the MICs as they're called. MICs have been exploding in growth, particularly after B20. A lot of these smaller developers that aren't as well funded or capitalized actually rely on them to fund construction. The MICs are actually getting regulated here in BC. They're basically removing an exemption that allowed them to not go through like a securities dealer. So they're basically going to be more scrutinized, and the cost of doing so is going to be a fair amount. I believe it's $200,000 they are saying for securities dealers. This is actually going to add on higher cost to any potential borrower. So if you're looking at a loan, maybe today a first loan comes in at 7%, that could tick up to 8%. But you're adding on more regulations and disclosures. So for anyone that is basically lending money into these MICs, a lot of the MICs were saying guaranteed 9% rate of return. Well, when you start to get heavily more regulated, you can't just start making those guaranteed rate of return assumptions. And then will that deter some capital from investing in the MICs, which ultimately lend back out to people? So that's small but interesting caveat that we'll have to pay attention to. As I mentioned, as the market continues to slow down and the negative news, the sentiment turns from optimistic to more pessimistic, all of a sudden people won't be as inclined to put their money into a mortgage investment corp, and that again will make lending or financing more difficult for a lot of the fringe borrowers. So we look at those credit spigots and how they're turning, so to speak. So anyways, that's all I got for this week. Very interesting market that we're entering into. I'm really fascinated to watch the sentiment shift. I think the condo inventory is building much quicker than the detached, simply because there's a lot more turnover. As I mentioned, if you're selling a condo or even if you're buying one, there still are condos, particularly the more affordable ones, that are still selling relatively quickly. So it's not a total liquidity crunch in the condo space. Still moving decently well, but again, the volumes are incredibly low. So once we get the inventory to build back up to normal levels, which it is doing so rapidly, that it's going to make liquidity worse. Again, as I said, in the detached market, I think those houses are becoming very, very liquid, particularly the higher up you go. So continuation of the trend in September. We'll see October, but otherwise, see you next week.